This is the second panel of the day. We're going to talk about global investment opportunities with our female portfolio managers. Very excited to have them. My name is Maggie Jiang again, SVP from Bank of China. The reason we are choosing a woman in investment panel is really we only see about 11% of women making up the investment industry. And here at Tcfa, we are having a 100% of women panel here, and really is a part of Tcfa's commitment to promote female portfolio managers, and we hope that they can also inspire more females to join the investment industry. We have terrific speakers that we can talk about the investment opportunities around the globe. We can also hear from them their views about women in investment. What are some of the issues? What can we do? Just a little bit about myself. My career actually started from buy side when I was assisting portfolio managers doing research. I ended up going to the sell side. The reason for that is I want to understand how the products are created, and later on, once I joined the sell side, created those products, I also went to roadshows to pitch to the clients. And so I'm really akin to the investors, and really I think it's because of them we can have a liquid market. So thank you very much for allowing me to be the moderator for today. A little bit about our panelists. From your left is Ming. She is Managing Director of Perella Weinberg Partners Asset Management Business. In her role, Ming is responsible for leading research in quantitative research strategic for PWP Global Micro Fund. Ming has over 10 years experience. Prior to joining Perella Weinberg Partners, she was with McKinsey Investment Office, and before that with IDG Capital. Next to her is Mei Gao. Mei joined IDG Capital as a partner in 2016 to focus on cross-border investment. Prior to joining IDG, she was president of Flow Research Management, which has been Tcfa sponsor for many years. Mei started her career in finance with TD Securities, where she managed a convertible arbitrage portfolio. She has very extensive experience in leveraged finance, equity-linked product, and derivatives, and of course, cross-border investment and PE. Next to her is Seema Hingorani. She is the founder and chairman of Girls Who Invest. It's a nonprofit organization dedicated to increase the number of women in portfolio management and leadership in asset management industry. She is a very prolific speaker on the topic of a more robust inclusion of women in corporate sector, and she has been recognized by numerous organizations for her dedication in the space. She's also founder and chief investment officer of Seven Step Capital, an opportunistic alternative seeding platform focused on investing in women portfolio managers. Seema came to us with many years of investing experience. Prior to that, she was Chief Investment Officer for New York City's retirement pension fund with AUM of $160 billion. And finally, but not the least, is Ouma Sananikone. She has served as Director of Macquarie Infrastructure Company since 2013. If you are familiar with infrastructure, that's one of the powerhouse in the street. Ouma also served in several board capacity. She has been board member of Icon Parking since 2006, and from 2007 to 2017, she was a non-executive director of Caisse de Dépôt de Paris and Quebec. Essentially, it's Canada's pension fund, which has AUM of $300 billion. Previously, she was CEO of Aberdeen Asset Management Australia, a division of Aberdeen Asset Management PLC. Ouma is extremely experienced investor, and she brings to us great insights from she brings with her a great insights from the top, CEO and CIO, and also from the boardroom. We are so delighted to have her. So thank you very much, everyone, for your time. The first question, given that we just listened to a micro panel, I would like to just follow up on that as to where, from the investor's point of view, where do you think the economic cycle is, and where do you think the opportunities are? And I'm going to join you on the table.
Yeah, the first one is U.S. Treasury yield curve. Historically, an inverted yield curve has always been viewed as an indicator of pending economic recessions. Over the past years, yield curve has been flattening. It is not inverted yet, but looks like it is heading to that direction. And can we look at the next chart, please? The second one is unemployment rate. Historically, a trough in the unemployment rate also tends to be a reliable predictor of business recession. Right now, unemployment rate is really low, below 4%. And the next one. The next one is called Buffet indicator. It is simply the stock market's market cap divided by GDP value. It shows where valuation stands. Currently, the Buffet indicator shows stock markets to be valued at about 140% of GDP. And this is among the highest level. It's even higher than the peak value in 2017 pre-crisis. The next one is margin debt. That's simply how much people borrow to buy stocks. So far, investors borrowed a record amount to bet on stocks. And it exacerbates sell-off if they're hit with calls to reduce obligations and forced to sell shares to raise cash. If margin debt continue to raise at this current pace, it is very likely that big sell-offs or sudden bouts of volatility is not a rare, they won't be rare events. So those four charts actually shows a pretty scary picture. Basically, they tell us that recession is very close. So the market actually has been nervous about many factors. However, I do have to point out that those are indicators, and most of them are not the cause of recession. To talk about the economic cycle and recession, we still need to look at the fundamentals of economic growth. So the GDP number right now, not there yet. Yeah, the GDP number is good, company earnings are strong, and labor market is actually awesome. So those shows U.S. fundamentals are still strong. However, there are real risk factors. One is the Fed tightening cycle. The second one is the trade war. And there are other concerns about inflations, earning powers, et cetera. So given this kind of economic background, the investment opportunities, before I talk that, I have to claim to say that this is my personal opinion, does not represent our fund's recommendation. So given we are in a Fed tightening cycle, one should avoid the short end of Treasury curve, and also be careful about rate-sensitive instruments. For example, some high-yield companies are going to start crumbling. And tightening favor U.S. dollar, yield curve flattener, and financial industries. And given great amount of market uncertainties, it's also good to use long-term bond and other safe haven assets to have a downside protection. So overall, it's good to have a well-balanced portfolio that can still take advantage of growth, but with good protection.
Thank you, Ming, for your view. I think just opposite to Ming, Mei is a PE investor, which has a long time holding Verizon. So we can hear from Mei to see, where she thinks the opportunities are in such an environment.
Thank you. I guess the month October that just passed, it's a month that lots of the investors would rather forget. But if you look at the underlying economic data, as Ming pointed out, they're actually very strong. And the recent volatility also probably masks the fact that S&P actually have generated a respectable total return of about 5% year to date. But obviously, market is pricing more risk. If you look at S&P's forward PE ratio, it stands at about 16, and it actually declined this year about 2 turns. So the consensus is that we are at late cycle, again, as Ming's charts show us, and earnings growth is going to taper off as tax cut effect has waned. But at IDG, we continue to view U.S. as an attractive place to invest. We continue to believe that consumer expenditure would grow, powered by low unemployment rate. So in the earlier chart, we see that unemployment rate currently stays at 3.7%, the lowest level since 1969. And we're also seeing significant wage growth. We see companies like Walmart, Target aggressively raising minimum wages. And in some of the progressive cities like San Francisco, Los Angeles, and New York City, minimum wages are going to be increased from $9 to $15. So in the long run, we think those can stimulate demand growth and also encourage investment and productivity growth in the long term. And as for investment opportunities, obviously in China, lots of the asset classes are becoming much, much more attractive in terms of valuation. The macro environment, as we all know, is more challenging there. But we believe the government is doing the right thing. As Craig earlier mentioned, some of the stimulus policies that the government has put in place. And the area that we found is most attractive is actually the private lending space. So as you know, the economy has slowed down. The government started the deleveraging campaign about 2.5 years ago. So we're seeing that the demand for private lending, private financing actually has surged. Even some of the very good performance are actually looking to the private lending space for access of credit. And we're seeing a robust supply of very, very good assets. On the competition side, the traditional provider of credit, like the Hong Kong arms of some of the Chinese investment banks and AMCs, are actually retreating from the market, so greatly reduce the competition. We're actually seeing lots of the attractive deals in the zip code of 15 to 20% annualized return with a very attractive risk-return profile. Thank you.
Thank you, Mei. That's quite a few different venue of investment theme. Appreciate that. We're going to go to Ouma next. Ouma, infrastructure investment. That's your forte, and that has an even longer duration. Can you talk to us? There's such a big capital outlay in infrastructure coming out in the cycle. Where do you think the different type of opportunities are? Are they the critical, social upgrade, all the types of different infrastructure? Where do you think the opportunity? And also following up to that, I would like to ask you, what is Macquarie's view or your view in terms of China's One Belt, One Road?
Before I go to infrastructure, I'd like to add that given the late cycle, there are all sorts of opportunities in non-infrastructure. And if you look at the non-GDP sensitive stocks and areas, and there are plenty of opportunities there. And even because if the companies are well run, and they're in areas where people still need to buy food, still need to buy medicine. So those kind of areas will always be less sensitive to obviously the gyrations of the cycles. And there are plenty of areas like that. And infrastructure is one of them. Infrastructure is a whole, I suppose, a whole selection, a whole wide selection of them. So from social infrastructure that has a total return of between 4% and 6% to, let's say, telecommunication that has a return to 12 to 18%, which is actually very rich in terms of IRR, to anything in the middle, such as contracted power, 8 to 10%, or transportation, which may be seaports, airports, between 12 and 10 and 15%. So those are very real and attractive returns that can supplement your total portfolio to produce the return, the long-term return that you want. And infrastructure is attractive, and it's in every country, particularly the more emerging countries that need to build up the infrastructure, be they pipelines for fuel, be there ports, be they new airports, be there schools, be they power plants, be they treatment of water. There's plenty of opportunities to invest in them. And so Macquarie, and indeed where I used to be before at the Caisse de Dépôt, that obviously with 300 billion, you actually need to spread your money around. They're very focused on infrastructure, not only in the first world, because the returns are more competitive, but also outside where the returns are much richer. And they're part of that building of the infrastructure. And in that sense, both, let's say in Canada, be they the Oumas, the teachers, the Caisse de Dépôt, or with Macquarie, there is a great relationship and dialogue being built up with India, China in particular. And the key there is to partner yourself with local partners who know the areas, who also know how to navigate, obviously, the regulation and the regulators and the political scene. But it's one of the areas that would always be with you, and obviously it's the areas that are less sensitive to GDP because of the reliable and stable cash flow returns.
What about One Belt, One Road? What's your opinion, and what type of opportunities out there?
I think the opportunities will always be out there if you take a longer term view, right? I think in the shorter term view, the political landscape will actually color and temper I suppose, and present challenges that people sometimes are fear that there's too much risk and too much volatility. But I'm probably the older person on this table, and I've been investing for at least 30 years and seen all sorts of cycles. So I think there are plenty of opportunities there. And if you look at China and its demographics, and one of the speakers, I think Greg Allen was saying, or perhaps Henry Fernandez was saying this morning, that China is going to, eventually China will actually become a power onto itself in terms of developing its domestic economy and all of the domestic infrastructures and consumption and so on. So I see plenty of opportunities there, and one should not be afraid of the 6 months, 3 months, even a year returns. You should really look at returns in the long term, and remember why you invest, and see your portfolio as a whole, and look at 3 year to 5 years investment. If you look at those kind of time frame, you become less afraid of going and looking at the opportunities, and less looking at the 3 months day-to-day returns and gyrations.
Thank you. Yeah, time is the best medicine for everything, and the best way for return as well. Now, next I would like to turn to Seema. Seema, you ran the 160 billion New York pension fund, and that's from the public side. Obviously, it's very different from the LIP on the private side. Can you comment on how does the public invest differently versus the private? Are there any special criteria that differentiate from others?
Sure. Hi. So talking about time horizons, we had a 30-year time horizon. At least that's what we were supposed to have. But clearly, everybody still looks at monthly returns and quarterly returns and yearly returns, especially against our competition. But nonetheless, that really is the time horizon on which a large public pension plan like New York City would consider investing. And so we did have an infrastructure allocation. We had a large private equity allocation, real estate allocation. So our alternatives portfolio was growing as I was there over a 4-year period, and it continues to grow as a percent of the portfolio. Although when you think about a public plan in the public sector versus in the private sector. So there are a number of laws that would prevent us from doing certain things, if you can believe it. So we couldn't go higher than, 25%-ish in alternatives. That was just by law. So even if we saw opportunities, we couldn't do it. So there were certain constraints on the New York City portfolio that we just had to live within. And so that just makes it more challenging as far as thinking about investment opportunities. And in some ways, the constraints were how quickly can we move? Well, one, we're 160 billion, although now it's a $190 billion fund. I left the position in June of 2014. And so given that size, there are just certain limitations in terms of how quickly you can move, and governance is very much about that. And we love the Canadians. We wish we could be like the Canadians in terms of the way they're structured, because we had 58 trustees and 5 boards. Can you imagine getting any investments done with that kind of governance structure? And yet we did get a lot of investments done, a lot of great investments done, but it makes it very challenging. And there are just other certain processes around diligence and how quickly we could do diligence on a manager before we could actually invest, so we wouldn't miss out on certain investment opportunities. Now when I think back on it, clearly the private sector can move more quickly. Hopefully not missing out on certain opportunities. And what we tried to do at the City of New York is shrink a lot of the time that it would take to do things. And so we changed. We actually were able to change a lot of the processes while I was there. And in fact, I'm very proud of this. I was able to change a law. That was pretty neat. And that was really important because it allowed us to diligence a public equity or a public fixed income manager a lot faster. So when I first showed up there, which was April of 2010, it would take us 18 months to choose a manager. By that time, you already missed the opportunity. You don't care about small cap US anymore, right? So what we did was we just came in there and analyzed the process and figured out where we could pull out, certain obstacles and bottlenecks. And we were able to get that down to about 8 months. And that wasn't even good enough. So in order, though, to get it down to 3 or 4 months, we had to change the law. And so I was a big part of that process in order to do that. And we ultimately did change the law, and that helped us a lot. But those are some of the constraints in which we had to operate. But the way I always looked at it is I think I became a much better investor because of it, because I still had to make money for teachers and firefighters and police officers for their retirement security. And they all have their different political philosophies on how they want their money managed as well. And so to still make them money within all those constraints, pretty hard to do, but we actually took our trailing 10-year performance before I showed up, which was 3%, and 4 years later we were at 7.5%, so
Wow.
It was pretty great.
Thank you. Thank you for the inside view about how to run a public firm. I know that we are running, out of time. I want to get our panelists to talk about quickly in terms of their view on China investment. Perhaps we start from Mei. And then we can talk about other issues, but probably just quick comments on your view on China's economy and investment opportunity.
Yeah, so obviously we're witnessing a slowdown in China. I would characterize that as inevitable because no one can grow that fast perpetually. But the positive side is that we're seeing that the government has put lots of the policies in place to support the economy. Greg earlier mentioned that they put the deleveraging campaign on pause, cutting the reserve rate, enact a personal tax cut, and also providing support to private enterprises, increasing the VAT funding for the exporters. And I think this is going to help to battle weak industrial production, softer property sales, and also weaker consumption sales. And we can already see some impact of those policies. As Remy mentioned earlier, if you look at the singles day sales, we're seeing Alibaba hitting 24 billion US dollars in 16 hours. If you put that in context, the whole US Cyber Monday sales is actually only $6 billion. I think this year is expected to hit 7-something But in China, only Alibaba in 16 hours is actually 24 billion. So I think it's a positive sign. So in IDG, we continue to see opportunities in China, and we always do what we are best at, which is finding the right entrepreneurs and providing with resources to grow the companies. And as cross-border investment is concerned, we're obviously taking a much more conservative view on the CFIUS approval process. But lots of the targets we look at historically are pretty much under the radar. They don't have very high security, national security concern. I'm not saying those investments don't have technology component. On the contrary, there is a very high level of technology and know-how. But because lots of a few companies in the US and Europe reach that level, so the industry is actually commoditized. They don't command a high valuation. So we were able to acquire those businesses at very attractive valuation and right-size the value chain and help them to penetrate a vast EM market, and so revamp the valuation of those investments. So to give you one example, in the cross-border side, we acquired Siemens residential LED light bulb business, then we were able to improve the cost structure and help them to penetrate Indonesia, India, as well as the Chinese market, and really growing the EBITDA. Thank you.
That's great. In the interest of time, I'm going to just ask Ming, see Ouma talk about China opportunity a little bit. So I'm going to ask Ming to quickly go through your thoughts, and then we are going to have Ouma talk about, the fundraising for women.
Yes, sure.
Portfolios manager.
Sure. To talk about a country's economy, I usually look at two things. One is their growth engine. Another is its risk factor. So for China's growth engine, it's a long story. So China's traditional growth engine, the manufacturing export, has been declining due to the rising of currencies and labor cost. And China is losing the status of world's factory. So, okay. And
slides, please.
So, and after that, China has been largely relied on the fixed investment, that's for the post-crisis. And China's state investment has been alarmingly wasteful and ineffective. Many targeted sectors have been plagued with overcapacity across country, which destroy investment returns. So fixed investment is not sustainable. And another growth engine that's ongoing, that is urbanization. China has great progress in urbanization, and urban population proportion has more than doubled since 1990. However, it still have a long way to reach to the urbanization level of current developed economies. So there's more rooms for more cities, towns, and infrastructure to build. And the next one is the more a new one called digital economy. China has one of the most active digital investment and startup ecosystems in the world. Can you show the slides? That is, yeah, the next slide. So that's a slide by McKinsey company on research. On the left, you can see that's a share of China's e-commerce in the world. So in the past decades, China's e-commerce share is starting from almost zero to now is 42%. That's greater than US and the rest of the world. And in the middle, you can see that's the mobile payment. China is 10 times larger than US. It's very interesting that I live in New York. A lot of people around me still prefer to pay cash or check, where people in China, literally everyone, that's the grandma, street vendor, and street vendor in rural area, they have mobile payments. That's a fascinating growth. So, and can we go to the next slide, please? So if we look at the GDP decomposition, we can see that the light blue one is the net export. It's been declining, sometimes negative. And we have a shrinking investment contribution, but a growing consumption-oriented growth. So so this is China's growth engine. And I would like to mention shortly the concern part, that's the debt problem in China. So China's debt has been rising significantly during the past. And the debt level is high, the growth rate is high, and relatively significant growth. So that's one risk factors we need to be cautious. So overall, my view on China is promising, it's big, it's biggest on everything, but it has challenges. One is the shift of growth engine and the shift from low quality growth to high quality growth, and the challenging of managing debt problem and build up credit system, etc. So I'm optimistic on China, but with great cautious.
Thank you, Ming, for passing out those two sides. One thing that Seema has been doing is very cool. She has been helping in her nonprofit, Girls Invest. She's been building a pipeline, giving internship opportunities, training female how to be a PM in the future. If you're interested, see her later on. But one other thing that I think is key in every female portfolio's mind is fundraising. Right? And, you know, from the example of FEMA trying to do a fundraising for a fund that's going to be featuring female portfolio managers, we can have her talk about her challenges and maybe how you guys can all help. And we can also have the panelists chime in terms of the experience on fundraising side.
Thank you. Yes, so after I left the City of New York job, I started two new initiatives. One is a nonprofit called Girls Who Invest, which Maggie mentioned, to get more young women interested in a career in managing money. And the other idea was to start a seeding fund called 7-Step Capital. And the idea there was New York City, in addition to a lot of other public plans in the country and a lot of institutional investors, have mandates and would like to invest in smaller managers, emerging managers, particularly those that are women and minority owned, to get much more diversity across the entire portfolio. It was very hard for us to find, so I decided to start a fund to go find them ourselves and then put them in business. And there's incredibly talented women out there, as we all know, that have incredible pedigrees and track records. And it's a matter of fundraising and capital raising, which is very hard to do for anybody, but it's especially hard for women to raise capital. It's unfortunately a thing, and so what I'm trying to do is change that. And so we found incredible talent so far. The pipeline is there. I'm out now raising capital to find some significant institutional investors to come on board to help me put these women in business. And the idea is to find 5 or 6 really talented women, which we've started to do, help them in those early years, the first few years, with operational resources and infrastructure, seed them with the investment capital. We may seed them with working capital as well if we need to, but really help build the next emerging leaders of our business who will look a lot different than the ones of the past. And so that's what I'm up to now.
In my conversation earlier with Seema, we talked about fundraising, and it is true that women, it's more difficult for women to raise funds because our network is not as established. But I think that increasingly organizations, be banks, be they technology companies, being Uber company, they're very aware of their brand and the value that they project to the consumers. And the consumers are young people and women. It's about representation, who want their voice to be represented, and they want the organizations that they consume, or that the products that they buy into, to reflect their values. And I think that women can use those kind of shifting values to be able to actually penetrate those organizations. And those organizations, especially you want to go to either huge pension funds, small, big, and investors, they even if they're not doing it for the right reason, if they're doing it because they want to appeal and make sure that their values are in line with that of their consumers, they will do it.
Absolutely. I mean, this is all about making more money, right? More women at the table, more diverse perspectives, you do make more money. It's been proven in research, and that's what this is. I'm going out there and finding a hugely overlooked opportunity, which is women. And as we all know, those are really highly attractive investment opportunities where nobody's looking. And so that's where we're going, and what we're finding is, yes, investors are starting to pay a lot more attention to this, because when you think about finding those places to get excess return, you want to go where other people aren't, and yet with incredible talent, with great track records. So it's not like we're just starting from scratch here with people and their experience. We're going after really experienced people to invest in. So I believe we have this huge opportunity to make a lot of money for our investors and change the world at the same time. And I don't know a whole lot of opportunities out there like that.
That's great. Do you want to just chime in very quickly? I think our time is up.
I'm good. I think for hedge fund industry, I don't see particular quite difference between women and men. So it's very, it's an industry that have great clarity. That's what I like about it.
Yeah.
Yeah, I just want to give a few words of encouragement for all the young mothers there out working in the financial industry. I mean, I'm one of you guys, and there is always a sense of guilt haunting me that I'm not there for my children. But now my children are older, they actually recognize, they actually appreciate the fact that I'm independent. So the other day I went to my older son and apologized to him that I'm not going to be there for one of his events. He actually came to me and say, "Don't worry, mommy, I don't mind because I like the fact that you're independent. You're not like some of the other moms." Sorry to say that, but because you're independent, you make your own living, you're not relying on your husband and your parents. So it's just hanging there, and I think your children would appreciate the fact that you're independent, and you are independent, and you will set a good example for your daughters and also for your sons to have the right perception of what independent woman should be. Thank you.
Thank you so much. That's such a great wrap-up for our panel. And thank you for coming. Thank you very much for our panelists, and see you later.
Thank you.
Thank you.